So this is Jim McRitchie, and this is a new platform. Eric Weinstein has been helping me put this together. Our first guest in a series of special guests is Brandon Rees this morning. And Brandon has been a long time at the AFL-CIO. I used to see when we used to go to conferences physically. I used to see Brandon at this time of year. I'd probably see him down in San Diego at the Corporate Directors Forum, where Brandon would be there talking about hot topics. And so I think he'll probably talk about hot topics for our group. What went on last year? What does he expect this year with regard to shareholder proposal and shareholder activism, and then also maybe touching on things that are going on in Washington, since you're in Washington and you've got kind of a good place to see what's going on and interact with those folks. So why don't I hand it over to Brandon and
Thanks, Jim, and thanks for having me. Yeah, as you alluded to, I've been with the AFL-CIO. I'm the deputy director, corporations capital markets for the AFL-CIO for over 2 decades now. And I know what you're all thinking. Geez, he must have started when he was in first grade. And I can reassure you that yes, that's absolutely right. I had an early interest in corporate governance issues, and so. First, I really want to commend you, Jim, for your work on shareholder activism, as well as for standing up to the SEC's misguided rule changes to the shareholder proposal rule, Rule 14A8, under President Trump. The lawsuit that you and ICCR and As You Sow have filed is really going to help protect the rights of shareholders to hold companies accountable. And of course, as many of you know, today's best practices in corporate governance arose in large part from the private ordering process of shareholder proposals. And our country has a long history of individual shareholder advocacy. The Gilbert brothers, of course, were the first shareholder proponents after World War II. They established many best practices, such as auditor ratification votes as a universal practice. They were also ahead of their times in advocating for gender diversity on boards. And Jim, your work as a shareholder advocate really carries on that tradition. So thank you. First, a little bit about the AFL-CIO. The AFL-CIO is America's labor federation of 56 trade unions with $12.5 million members. We represent workers from every walk of life. In our newest affiliate, the Women's National Soccer Team Players Association, their members today just won a historic $24 million equal pay settlement that you may have seen in the papers against the U.S. Soccer Federation. That lawsuit was filed after the women's team twice won the World Cup, but the men's team failed to qualify in 2019. So it's a great day for equal pay. And so our hats are off to them today. America's workers are major shareholders in publicly traded companies through our retirement savings. There's over $15 trillion in retirement plan assets in the United States, and that's divided between single employer corporate sponsored plans, public employee pension plans, and Taft-Hartley or multi-employer pension plans. And union members participate in all 3 types of these plans and are disproportionately represented by the fact that of course, many decades ago, far greater numbers of U.S. workers were in labor unions, and B, negotiating retirement security and ensuring that union members have a secure pension plan has always been one of the highest priorities for labor unions in this country. We view the retirement plan assets as the deferred wages of working people. And our capital stewardship program, which I help administer, is designed to enhance the retirement security of working people by aligning the investment of those funds with the long-term horizon of pension plans, which is at least as long as the life expectancy of plan participants and beneficiaries, and potentially an infinite time horizon as new plan participants come into a retirement plan. To that end, we strongly believe that working people deserve a voice in the capital markets and in the corporations that we invest in. We strongly believe that pension plans should act as responsible investors and not simply as passive shareholders. Working people deserve a voice in the corporate governance of today's companies. And it's our view that shareholders do the best over the long term when all stakeholders are taken into consideration. And for us in the labor movement, this isn't an academic question between the debate between shareholder primacy and stakeholder capitalism. It's a very real question about whether working people will be able to retire in dignity after a lifetime of work. And we can't allow the nearsighted vision or short-termism of corporate CEOs or Wall Street money managers to compromise our ability to ensure that companies are investing for the long term and for sustainable growth. That's really the lesson of the Enron era corporate malfeasance. Behind me on the wall is a stock price graph that I keep in my office of Enron that was a exhibit in the shareholder lawsuit after the company's bankruptcy. Of course, in that bankruptcy, thousands of Enron employees lost their retirement savings when their 401k plan was frozen and had been stuffed with company stock. They also lost their livelihoods, their jobs, their communities where they spent the best 8 hours of every workday. And one of those workers was the father of my boss, AFL-CIO President Liz Schuler. Her father was an IBW lineman at Portland General Electric that had been recently acquired by Enron. And he too lost his 401k savings in the bankruptcy. Every day I look at that stock price and I'm reminded of our sacred duty to safeguard the retirement savings of working people. I think Judge Cardozo famously said it almost 100 years ago, that a trustee is someone who's is something that is stricter than the morals of the marketplace, and not honesty alone, but a punctilio of honor most sensitive is the standard for behavior. So that's what guides us in our capital stewardship program, how we approach corporate governance issues. I look forward to the conversation today. I know there's a lot of interesting issues in corporate governance that we can talk about, and look forward to the conversation.
Well, I'm going to start with one question is executive pay watch. That seems to be one of the more popular things that the AFL-CIO has done over the years. What kind of feedback are you getting on that?
Yes, so we launched Executive Pay Watch back in 1997 when I first started with the AFL-CIO in first grade. It's continues to be, one of the most visited portions of the AFL-CIO's website. The goal really was to help the public and help investors and help working people better understand the role of runaway CEO pay and its impact on economic inequality in our economy, as well as the risks that it posed for shareholders of companies, including our retirement savings. So in 2020, and we update the numbers each spring. So as the proxy season unfolds and the new data comes out, we'll be updating the numbers for 2021. But as of 2020, the average CEO of an S&P 500 company received $15.5 million in total compensation. It's a life-changing amount of compensation for one person. And it's equal to 299 times the average or median workers pay in the S&P 500. We are worried about runaway CEO pay, not just because of its impact on economic inequality, but because we fear that it promotes short-term decision-making by corporate CEOs. The siren song of a life-changing pay package can cloud even the judgment of even the most loyal and long-term thinking CEO. When you can have choice, making the choice between investing in the company's operations, training for its workforce, research and development, versus say stock buybacks that will temporarily boost the company's stock price and also help the company meet its earnings per share metrics, which are often a performance metric in CEO pay. So for those reasons, CEO pay reform has always been high on the labor movement's pension plans agenda for corporate governance. We've been the advocates for important reforms like limits on golden parachutes, for reforming the use of equity compensation, including stockholding requirements for executives, specific performance standards, and the like. So yes, so CEO pay is always an important and hot topic, and it's material not just because of the dollar amounts involved, but because of its impact on executive decision making. And we're still grappling with how the best way to do it, right? And one of my pet peeves in corporate governance is that too many institutional investors see total shareholder return as sort of a justification for high CEO pay. But we have to remember that total shareholder return is not tied to executives' individual performance as the CEO of the company. There are many external factors that drive stock price performance. Are we in a bear market, bull market? Is the sector in favor, out of favor? And what we should really be thinking about when voting on say on pay is how can we best align the executive's individual performance goals to the key metrics that create value for the company, its shareholders, and its employees. And I don't think we're there yet. It is a topic that was addressed by the Dodd-Frank Act, which has not been addressed yet. Section 956A requires the SEC to disclose pay for performance. Requires the SEC to issue new regulations to have companies disclose pay for performance. They've just reissued that release for comment by investors, and they've enhanced it. They've enhanced it to ask companies to identify the key performance metrics that are actually being used to determine CEO pay. And it's my hope that this will lead to more thoughtful say on pay voting and ultimately more thoughtful design of executive compensation plans by boards of directors.
Yeah, it seems like even thoughtful voters aren't really addressing the annual ratcheting up of CEO pay. I mean, it seems, in my, outsider's view of it, it seems like, okay, every year they do an annual survey. Their compensation consultants survey, okay, what are their peers getting, or what are people getting paid, and then the board says, okay, well, our CEO is, of course, above average because otherwise we would fire them. They must be performing above average because they're our CEO. So, and oftentimes they put that at the 75th percentile level. So if you're measuring every year what people got paid, and then you're putting yourself at the 75th percentile level, or even just above average, then the next year you come back and you do your salary survey again. Well, salaries or not salary, pay, total pay packages, and the pay package goes up. And I'm thinking about running for the CalPERS board. So I talked to people at CalPERS a few days ago, asking them, well, what are you doing to stop the ratcheting up? And they're looking at pay for performance, and they think that some of their metrics get to that kind of abuse, but they're not really. I don't know. Is anyone doing? I mean, I know there are some funds that say, okay, if they get paid, 150 times more than the average employee, we're voting against them in the compensation package. But do you know other approaches that people are taking to try to?
Well, what you're identifying is, one of the key problems in corporate governance that, when A board of directors is setting executive compensation. What the compensation committee really has two tasks. One is to identify the performance metrics that will incentivize, purport to incentivize the executive to focus on particular metrics to receive the compensation. So that's part of the job. But the other part of the job is then to assign a magnitude or dollar amount of compensation that would then be awarded to the executive. And that's where shareholders have really dropped the ball. I've been in too many conferences, too many meetings where, a proxy voter from some institutional investors says, I care only about pay for performance and I don't care at all about the magnitude or quantum of pay. And that's problematic. And it's problematic because high CEO pay in itself is a risk factor. First of all, I believe we're on a backward bending labor supply curve for CEO talent. The more you pay them, the fewer years they're going to work. Secondly, as I spoke to before, high CEO pay can lead to executives taking short-term decisions that are not in the best long-term interest of the company, right? If I can goose the stock price this quarter, I'll be able to cash out my stock options, and the costs of that decision will only be reaped by shareholders over the long term, long after I've retired. And then the last risk factor is the corrosive effect on runaway CEO pay on organizational performance and collaboration. I don't care if you're the CEO, you're one of the next named 5 executive officers, the CFO of the company, or if you're a rank and file employee, the median employee of the organization. When you see the CEO receiving the lion's share of compensation, it sends a dispiriting message that all value is created by the CEO, and the rest of you are mere factors of production. Whereas a company in which the CEO's pay philosophy is internally aligned with the company's overall compensation philosophy and in line, with the appropriate amount of compensation, that fosters collaboration, that fosters teamwork. It encourages employees to go the extra mile for their employer because they know that they're all in it together. And that's what's missing from today's calculations regarding say-on-pay votes. Dodd-Frank, again, attempted to address this issue by requiring the disclosure of CEO to median employee pay of the organization to give investors a simple yardstick. Now that rule, I think actually was even more beneficial in cracking the window on human capital management disclosure. Before we had the pay ratio disclosure, we had no idea how much companies were paying their workforces. This is, of course, at the same time that many companies are saying that their workforces are their greatest asset, right? But no information is being provided about the most important metric for that workforce, which is their compensation. Are we a high road employer creating good jobs with high productivity workforce, or are we a low road employer which suffers from high turnover and is really just paying a market clearing wage to keep costs down and boost the share price over the short term? So those are the issues that I see ahead of us, and I believe we're still working on with the institutional investor community.
Well, 2 things come to mind there. One is EEO1 reports. At one point, I thought they were supposed to report pay along with and I'm not sure if you know what happened, but in my mind, what happened was under Obama, the rules that were proposed was supposed to be, okay, they're reporting the EEO1, who's in that category, to the Department of Labor, and then people are now asking through shareholder proposals companies to report that information. But they were supposed to, I think, start reporting pay And I think maybe that went away when Trump came into office. He was able to squelch that. I'm not sure. But another thing,
That's my recollection as well, that
okay, yeah,
the DOL was collecting the information. It was not publicly available to the investors of the company.
uh-huh,
And again, because of the shareholder proposal rule and investor advocacy, companies are now voluntarily providing that information and supplemental reporting to investors of their workforce's diversity, and that's an unequivocally positive development.
right,
Um, and but as you mentioned, investors are still looking for information about the compensation and how it's
right,
broken down, not just the EEO data, which is currently disclosed along, along job classification, right? Are you a managerial employee? Are you a professional employee?
right.
Are you a production line employee? I see Christian's got his hand up. I don't know if you want to recognize.
Sure.
Uh,
Yeah, thanks. This is a fascinating topic. And Brandon or Jim, I looked at these data, I don't know, a year ago. And I remember back in the 70s, the ratio is more like 40 times. It was that different that recent ago. I mean, to me, the 70s is recent. It's in my lifetime. But I worked at Sanford Bernstein in the 90s, and we did a big deep dive research into this topic on our strategist, Michael Goldstein. And I remember his theory was that the expansion of executive pay had a lot to do with using stock and stock options in addition to cash. And it was also a way to shift the cost of that level of employee onto, diluting the shareholder base. And he even matched share buybacks to the expansion of the shares by companies needing to, buy back the shares from the stock options that get granted and then executed. So to what degree is the expansion of that multiple due to using stock and stock options as pay instead of cash?
Sure.
I assume it has something to do with it, just as a mechanism.
Yeah, I think you're absolutely right that there were many investors who advocated for better aligning CEO pay with shareholder returns through things like stock options. Although part of the problem is that shareholders are not option holders, right? Stock options provide all the benefit of share price increases with none of the risk of share price declines. They encourage a shoot for the moon mentality in when executives are making decisions. And all that's lost as well. If you crash the stock price, you're getting another tranche of stock options awarded to you the next year. You're going to make out like a bandit just to get the stock price back where it is. And so there's also academic research that stock option compensation is correlated with greater share price volatility. Well, as an investor, share price volatility is a measure of risk, all things being equal. So why are we paying executives with a form of compensation that's actually more valuable the more share price volatility there is? It's right there in the Black-Scholes option pricing model. The higher volatility, the more likely the options are going to be in the money, even if the long-term returns are nil. And I think that your point goes to the issue I was raising before about many institutional investors just seeing total shareholder returns as a moral justification for high CEO pay, right? And if we we can't complain if high CEO pay is aligned. But the problem is, it takes many decades for a CEO's decision about whether to invest in the company today play out over the long term. And so it's, it really is my belief that, again, high CEO pay is a risk factor that leads to nearsightedness by corporate CEOs who, many do want to invest for the long term and care passionately about the companies that they run. But that it's hard to set aside the fact that you have this life-changing payout.
Just to clarify, I mean, we were very much against using stock options and stock as executive pay. And Mike made the point, which was interesting, that it might be appropriate for a startup that has no cash. It's like sweat equity, but it's not appropriate for, an S&P 500 well-established 50-year-old company or like a JP Morgan or something like that, because you have the cash to pay your employees. So.
Right. Well, and yeah, it also, you're raising the issue of stock option expensing in that debate as well, right? That
Exactly.
companies were essentially hiding from investors the cost of their saving cost, part of their CEO compensation, as well as compensation for the rest of the workforce by not expensing stock options, and that's something we fought for, and we're able to achieve, again, in part through the submission of shareholder proposals. I think that today's investors, it's worth looking back at, how did we get to where we are today, and what was the role of share owners as advocates, engaging with companies and educating the public around these issues. So now I think we're very much still looking to put the genie back in the bottle and on CEO pay, and it does have important impacts. Your comments reminded me of the Business Roundtable's statement of the purpose of the corporation that was issued a couple of years ago, and sort of restating their views on what some have termed stakeholder capitalism. Others have derided as being trying to turn back the clock to managerial capitalism, that we had in the post-war era, in which companies CEOs really had discretion in terms of managing the company, and no one was watching them. But I don't believe we can turn back the clock, and we instead need to be thinking forward about how investors, how responsible investors in particular, including workers' pension plans, can best advocate for rules of the game that will provide for broad-based prosperity and long-term decision-making by corporate CEOs. So, and CEO pay is a critical part of that, right? That's what drives the decision-making. And so, for example, we're encouraged this year. We're encouraging a hotel company that had a low say on pay vote to include customer satisfaction as a key performance metrics in their CEO pay. I don't know if many of you had the opportunity to travel during COVID-19, but there have been some pretty dramatic changes in the hotel industry, related to the fact that many of these companies laid off significant portions of their workforce or furloughed them during the COVID-19 recession, and now haven't brought them back. So you can't get daily housekeeping, for example. I was staying at a hotel with my family over the summer, and their policy was, well, due to COVID-19, we don't offer daily housekeeping as requested, as opposed to an opt-out thing, as it historically has always been. When you stayed at a hotel, you always put the do not disturb sign on your door, and I had to plead with the hotel front desk. It took several days before I could get housekeeping. Meanwhile, my room with my two teenage daughters, was becoming like a Superstorm Sandy, Superstorm Katrina, Superdome type situation, with trash piling up, dirty towels. It wasn't the experience I was accustomed to as a long patron of hotels. So anyway, we're hopeful that we can align CEO pay to include things that actually are directly connected to value, directly connected to CEO decision making, and that includes things like if you're a hotel company, a hotel operating company, is your pay aligned with customer satisfaction?
So, Chris, I see you've got your hand up.
Well, maybe just a remark to add to the hotel thing, that for years we've been seeing those little cards, if you don't want your towels and linens changed today for the care of the environment, but underneath that was also the whole drive to try and reduce those sorts of labor costs. And, as an organization, one of the things that we try to, I think you've articulated very well that the business case and the risk case associated to it, to the rampant executive compensation. But there's the kind of moral case that it also has driven so many of our members around this question. Our founder, and you and I have talked about this before, Brandon, our founder, Father Mike, one of the last campaigns he was a part of before he died was trying to push 12 different retailers to increase the wages for their workers. At the end of the day, the SEC ruled that those could be omitted, but we've long advocated for raising the federal minimum wage, for seeking a living wage, and that there is the question of how high can the top go, but also what can we do to, help especially those at the bottom. And this year, a number of shareholders, including our members, have filed with a number of restaurants to seek better wages for those workers, to kind of put the pressure from the other direction as well. But yeah, these kinds of things are just such critical concerns for society. In 2013, President Obama made, I pulled up the quote because I think it's so important: rising income inequality is the defining challenge of our time. And in that same year, Pope Francis said, how can it be that it is not a news item when an elderly homeless person dies of exposure, but it is news when the stock market loses 2 points? That the voices of faith-based shareholders want to stand alongside those of unions and of organized workers in those respects to advance a more rational form of compensation, not only at the top, but across the board. Maybe I'll close my remark at that point, other than to say you've probably also seen the news about ISS and Glass Lewis's recommendations regarding Apple's upcoming vote on that one. I don't know if you want to make any comments about that.
Well, I think your point is well said, and of course, the shareholder proposal process has been, is really the conscience of the corporation, right? And it's been part of our U.S. corporate governance fabric for so many decades. It's really what the right of dissent. And what we saw under the Trump administration was an effort to silence that dissent, right? That there was both reforms proposed to the shareholder proposal rule to keep folks like Jim McRitchie, as well as union members, from being able to file shareholder proposals. And there was also an effort to keep our pension plans from voting against management. One of the safe harbors that the Department of Labor proposed was that, well, you could always vote with corporate management. Management's always right. And that is the perspective that corporate CEOs have. Of course, we're always right, but all CEOs can't be always right all the time. And we would be breaching our fiduciary duty to pension plan participants if we always voted with corporate management. And that's been the understanding, going back decades since the Employee Retirement Income Security Act was passed in 1974. So, I think it's still an evolving landscape, the issue about what kind of jobs companies are creating. An important component of that is what type of turnover they're experiencing, right? I just received a letter. Let's see, I'm not sure if I have it in front of me, from the Society of Human Resource Management saying, is the Great Resignation a problem for your organization? And according to them, it's unequivocally yes, that companies are struggling with workers quitting their jobs or not coming back to their jobs after they'd been furloughed during COVID-19, understandably, or seeking more stable and more loyal employers that will seek to build a long-term relationship. And it speaks to the ability of companies to create value, right? So back in 1975, I think the average the intangibles on a company's balance sheet were only 17% of total assets. Today, for the S&P 500, it's over 90%. Of value is our intangibles. And where do those intangibles come from? Well, they're created by the workforce in terms of goodwill, brand name, customer relationships, intellectual property. That all comes from the workforce. And the problem is that our disclosure rules and our accounting rules have not kept up to this changing economy. And those companies that succeed are those that are that partner with their employees, create good jobs, and are willing to invest in them, and recognize the cost of high employee turnover on the company in terms of retraining costs, in terms of lost firm-specific human capital, right? I mean, that's one issue that I think is underappreciated, just how much a worker's knowledge about how their company does things and how to get things done in their job, how important that is, and is not necessarily transferable to another employer. So it's my hope that investors will take the forthcoming human capital management disclosure information that SEC Chair Gensler is currently working on, and be able to have a much more high level conversation with companies, with boards of directors, so that we can start to build an economy that works for all.
One thing I'd like to see, and I should submit a comment, I guess, before a proposal comes out, which could be any time, for human capital management. But since 2003, I think, companies have had to report or have had to go to a vote for compensation, incentive compensation, which is mostly, I think, now not in the form of options, but in the form of restricted stock, probably. And so I've been talking to a bunch of different companies, and it seems like, I could be wrong, but I think most companies report restricted stock that goes to the named executives. They have to report that in the compensation table, I think, and then they report what goes to the board members. But we don't see anything about what goes to employees below that executive level. So that's one of the proposals I have. So last year I had proposals, and I saw that that AFL-CIO has a proposal at Activision Blizzard that's similar to, somewhat similar to what I had last year, although yours has a little different twist. What I had was kind of a Rooney Rule proposal. Okay, let's at least get a worker in the candidate pool, whereas what I think you have at Activision Blizzard is, let's get a worker on the board. Is it a direct kind of thing like that? But so that's one question. And then the other thing is, what I've done is, since I didn't get very far with those, and not even the pension funds, public pension funds, who have workers on the board of directors of the public pension. When I talked to those workers, they'd say, yeah, sure, we would vote in favor of that. But then the people that do the actual voting, no, they vote against it. So what I've done this year is ask for, okay, tell us how you've distributed those shares below, those incentive shares that we voted in favor of. Where did those shares go? At what level in the company? So a couple of issues there for you.
Yeah, exactly. So, well, you raise a lot of issues. One, last year, the AFL-CIO, we had filed a shareholder resolution at Activision asking the company to adopt the Rooney Rule for its employee hiring, which, for those who may not know, is named after the NFL football coach who helped to diversify the NFL's by proposing that whenever interviewing candidates for head coaching positions, and it's since been expanded to include other positions in the NFL, that the hiring entity would have to consider qualified minority candidates. And so the idea here is that that to expand diversity, we need to ensure that the pool of talent being considered is diverse, and it has started at the board level, right? So many companies have adopted that, and many pension funds have voted in favor of that. And then our goal was to expand it through the workforce, which many companies and some industries, in fact, are taking a leadership and have done. Activision had adopted similar changes as well to its own hiring. The proposal ultimately got excluded. This year, we've come back with a new shareholder resolution, which and it is a little bit different than most shareholder proposals, seeking to include an employee representative on boards of directors. One of the issues is how do you ensure that employee representative represents the interests of the non-management workforce of the company? In order to get the benefits of dialogue and cooperation between labor and management, you need to have a independent worker voice on the board. And one of the challenges, given the state of union density here in the United States being at historic lows, is how do you ensure that absent collective bargaining? In countries like Germany that have co-determination, where half of the board seats for large companies are worker representatives, you have a strong trade union tradition and high levels of union density in which workers can exercise that voice to identify those representatives. So our proposal is asking that the company nominate a worker elected candidate. So and we're not defining what process that would take place through, but that it should be by virtue of a democratic election, and that's intended to prevent the employee being simply a crony of management, right? An insider that is not adding a diverse perspective, the perspective of the company's rank and file workforce. So yeah, that's the new wrinkle we've introduced at Activision this year. We anticipate that we'll go to a vote, notwithstanding the announced merger with Microsoft. And we do think it would be beneficial, particularly at a company like Activision that has had such struggles with diversity, as well as allegations of sexual harassment and other Me Too type problems that we think could be helped rectified in part by having employee representatives on the board.
Great.
And I guess you also asked about employee equity compensation as well, which was whole another topic we could spend another hour on. We at the AFL-CIO, we believe employee equity compensation, is appropriate. Profit sharing is appropriate, but only after workers' basic income needs, their retirement is well provided for, and they have adequate health insurance. And too often in the United States, equity-based compensation is a substitute for that base pay, not a complement to it. And so that's exactly what happened at Enron, right? Enron workers only had a 401k plan, and it was stuffed to the gills with company stock, because that was the culture. That's what the workforce was being told, that their stock going to the moon. You're going to be a millionaire if you keep your 401k in company stock. And so and another point you're raising is the decline in broad-based equity compensation plans. Again, part of that followed option expensing that companies decided they didn't want to grant equity compensation more broadly to the workforce if they had to account for it properly. And to be realistic, I mean, for example, Walmart recently announced that they were I believe eliminating or phasing out their broad-based equity plan for its workforce, for its rank and file workforce. As a worker, who has to worry about meeting their monthly rent, I can't use my stock options to do that, right? I need $15 an hour as a minimum wage. And so I think that once we achieve that, then the idea of fostering collaboration and sharing of profits becomes a real possibility.
Another concern that I wrote down here is key vote survey. I'm not sure if you're still doing that anymore. I haven't seen it lately. Maybe you're still doing it, but one way I used that was I looked at my own. So I used to work for the state of California for 30 years, and I looked at the options that we had available. You know, of course, we have CalPERS for our retirement, but you also have 401k plans and other things. And I looked at how they were voting our shares, and I compared that to the key vote survey that the AFL-CIO put out, and basically I saw that the fund, that the S&P 500 fund that was made available to state employees, and that's where almost all the money went. There were some other options, but most of it went to that S&P 500. They voted against everything that we worked for during the day. You know, they voted against the environment, they voted against education, they voted against, you know, women's rights, you know, basically everything that state employees work for, you know, health and safety issues, other things. So I found it very helpful, although it wasn't as helpful as you know, because even though I raised that as an issue, I still couldn't get the governor's office to say, okay, well, let's change. They did get a slightly better S&P 500 as far as voting, but nowhere near what it should be. So, Brandon, where's the AFL-CIO? Are you still doing that thing?
Yes, if you visit invest.aflcio.org, it'll take you just to the page that has our AFL-CIO key vote survey. We've been doing that since 1997 as well, in addition to our executive paywatch website, which the URL is www.paywatch.org. That you and the AFL-CIO key vote survey is a tool for pension plan trustees to be able to evaluate and compare asset manager voting on issues that we've identified as being key issues for the proxy season. So each year we identify a series of 20 to 30 votes, and we survey asset managers, and we collect mutual fund proxy voting data from Form NPX filings with the SEC. And then we give them a scorecard, right? Are you voting with the AFL-CIO's proxy voting guidelines or against the guidelines? And there are many asset managers that vote 100% with the AFL-CIO proxy voting guidelines. There is in a second tier, the middle tier, which vote with us more than 50% of the time, and then the bottom tier, which is less than 50% of the time. And that really is, I think, one of the problems. It's not just whether they're voting with the AFL-CIO's proxy voting guidelines, but it reflects the fact that many large investment managers, particularly the very largest index providers, BlackRock, Vanguard, State Street, have historically routinely voted with corporate management. You know, it's our concern is that in part, money managers' reluctance to vote against management reflects conflicts of interest, right? That they're managing corporate 401k plan assets. They themselves, of course, may also be, you know, publicly listed companies in their own right. And so the purpose of the key vote survey is to remind asset managers that when voting, they need to be voting in the best interest of their clients, be it pension plans or be it mutual fund investors, and not being overly deferential to corporate management. Since we've been doing the survey, we have seen a dramatic improvement, I think, in the independence of asset managers to vote in the interest of their clients and not in the interest of the CEO. You know, votes against boards of directors are more common. Votes against say on pay, shareholder support for shareholder resolutions on ESG issues has grown tremendously. So those are all positive features, but it only comes through investors having that dialogue with their asset managers. to ensure that they reflect, their best interests. And so, yes, now I'm glad you mentioned the key vote survey, but like I said, I've been doing it for many years. So I'm glad that someone's noted it and still finds it useful.
Well, I'm
So
glad it's still there because I couldn't find it, although I didn't look very hard. I just thought, oh, okay, we're going to be talking to Brandon. Let me just look and see if that's still out there. And I didn't. I missed it.
yeah, and one that was, one of the most outrageous things, again, that was, proposed by the Trump administration, that pension plans, could avoid their fiduciary obligations to vote in the interest of plan participants and beneficiaries by always voting with corporate management. That was the safe harbor. They also proposed you didn't have to vote. You only have to vote, if you owned 5% of a company's stock. Which of course no pension plan would ever have such a concentrated stake. And so, it was basically an attack on voting and the institution of voting, something which I guess the previous administration was fairly familiar with as things happen, as events transpired on January 6th. So.
Voting machines. Yeah.
If I could follow up, just out of curiosity, do you see a difference in the attraction your proposals get when they are more clearly aligned with your constituents, meaning that the proposal is much more focused on pro-labor worker rights versus, say, other social or social justice oriented proposals that fall more in the line of minimum wage, living wage, child labor, things of that nature? Is there a difference in the votes? And in terms of the asset gatherers, who's more behind what kind of proposal that you might be behind, at least in that realm? I know you've got proposals across the board in other areas.
Well, I think that if anything, the labor movement needs to do a better job in promoting workers' rights to collectively bargain and the freedom to negotiate with employers for improved wages. These are human rights, as defined by the International Labor Organization's core conventions, the right, freedom of association and right to collectively bargain. And much great work has been done over the years by, not just union members' pension plans, but also other socially responsible investors and ICCR members to promote workers' rights as a core value. Many companies today now have respect for the ILO conventions as part of their business code of conduct and as their supplier codes of conduct. It's I think, while I don't believe there's ever been a majority vote on such proposals, raising the issue has been, through the shareholder proposal process has been a successful one. It's an ongoing conversation. There's a shareholder proposal pending at Amazon this year asking for a report on its ILO compliance with international workers' rights obligations. We'll see what happens with that proposal. I do think it's something that investors today are much more willing to embrace, given the importance of the recognized and growing recognition of the importance of human capital management and workforce issues to the company's success.
I'm assuming Amazon went to the SEC and asked for a no action on it. I don't know.
No, not that particular proposal, which was filed by a Canadian fund. And in fact, they may be issuing their own report, whether or not it actually encompasses all the issues being sought to address, I think remains to be seen. But I think it's obviously an important issue for Amazon investors as well as workers at Amazon. Is the company going to be transparent in its labor relations? Is it going to continue to seek to avoid unions by hiring expensive union avoidance consultants? Is it going to plaster its workplaces with anti-union messaging and create a culture of fear and intimidation? Or is it going to let its workforce, make a free and independent decision when to form unions and to negotiate for improved wages and benefits.
Eric, did he get to your answer? I'm not sure.
So I do you notice a difference in the number of votes or the percentage of success that you're achieving between a pro unionization type proposal or something along those lines versus a minimum wage type proposal, which the latter, which might be viewed more broadly as a along the lines of a beta investing as opposed to something more focused or narrow, even though it's fairly large. Is there a difference, and do pension funds, are they more supportive of that type of proposal? I would expect them to be, but I don't know what, I know there are more recent changes likely with what they think their fiduciary responsibilities are versus say a large asset gatherer like BlackRock or Vanguard or somebody else.
Well, our plans, we vote for all sorts of proposals, right, to improve workers' wages, because we think it's important to improving the corporation's long-term performance as investors. And if anything, I think that wider shareholder support from the institutional investor community has not been high enough as it should be for either type of proposal. Like I said, I don't think, we put forward proposals on a variety of topics, right? Affecting the workforce to prevent workforce discrimination. We recently were filing shareholder proposals on mandatory arbitration, which had been identified as a way that by the Me Too movement is something that was preventing workers from seeking redress when they faced sexual harassment in the workplace. But a lot of it's also limited too by the rules the SEC has set, right? That if it strays into the ordinary business of the corporation, that is, a topic that shareholder proposals are not supposed to address. And I think the SEC historically has been slow in recognizing emerging significant social policy issues that are an exception to that rule. And that are therefore meritorious for a shareholder vote. So again, I've complete confidence in our current SEC chair, Gary Gensler, and his respect and recognition for the importance of both the shareholder proposal rule and of workers having good information to make good investment decisions. So I'm envisioning a day where shareholders won't have to ask for things like reports on do you pay a living wage to your workforce, because that will be something that every company is required to provide.
So with regard to the freedom of association proposal, which I think it's a great proposal from Share, I'm looking at that thinking, okay, if that goes on the ballot and if it gets a high vote, that might be something that I might submit at a bunch of different companies in the future. Is that something that the
Well, it's modeled on previous resolutions that have asked companies to incorporate the ILO core conventions, and it was particularly common in over the years in retail-facing companies, right? So garment retailers, for example. And there's been an evolution in those proposals, right? The first generation of proposals asked companies to simply commit to respecting the core conventions of freedom of association and right to collective bargaining. And then it became a question of implementation and transparency, right? Does the company recognize external grievance processes for workers to be able to bring forward complaints, and that could either be through a collective bargaining process or participation in other international sort of soft law mechanisms like the OECD complaint process for under the OECD guidelines for multinational organizations. There's a voluntary complaint process that workers and other aggrieved parties can use to bring forward their concerns regarding respect for human rights. And so, but a company like Amazon's got a long way to go, right? They haven't yet committed to reporting, and that's what this proposal is seeking.
Can you talk a little bit more about retirement assets, substantial amount of money that sit in various different pools? A 401k, somebody may have, maybe a lot more accessible in terms of switching a fund than, say, a pension fund. And then in between, there could be, employee stock ownership plans that are managed by trusts, and then there are other pools as well. Which ones do a good job of representing their beneficiaries, and which ones are totally divorced? And where are we in potentially reforming some of those?
That's an excellent question. Retirement security in the United States has long been thought of as a three-legged stool, right? You have Social Security, you would have defined benefit pension plans that provide a lifetime of income, and then you have individual retirement savings is held by 401k plans. Of course, over the past several decades, we've seen a shift away from employers' willingness to provide defined benefit pension plans to 401k plans, a transferring of risk from employers to employees. For many reasons, 401k plans are less secure than defined benefit pension plans, and also more costly to plan participants. And you also there see, I think, a breakdown between the interests of plan participants and the votes that are cast on their behalf. That the mutual fund industry, which primarily services 401k participant directed plans, has the least independence when voting on proxies. And so their mutual fund companies are routinely in the bottom tier on the AFL-CIO key vote survey, for example. Whereas for defined benefit pension plans, both public employee pension plans as well as union members, multi-employer pension plans, which are overwhelmingly defined benefit plans, the law has long been clear that those plans have to ensure that votes are cast in the best interests of the plan participants. And so for that reason, you've seen a focus on proxy voting, both as a fiduciary obligation, as well as a way to create value, right? By making companies more responsible, more accountable. And that directly reflects, I think, both the legal obligations, but also the structures of those plans, right? That public employee pension plans often have worker representation on the boards of trustees. Multi-employer pension plans for union members have joint labor management boards of trustees. So there's worker voice in the management of those funds. And so for those reasons, those governance reasons of pension plans, I think have a big impact on things like proxy voting, which is exactly why Eugene Scalia, as the Secretary of Labor under President Trump, tried to shut down pension plan proxy voting. CEOs did not like shareholders having their own voice in shareholder meetings and voting against management. Too many CEOs, subscribe to the Victorian view of children, that they should be seen and not heard, and that's just the reality. But we can't turn the back on shareholder democracy. We need to move forward and build better systems to ensure that the true owners of the company are having their voice and their interests heard. That's that really is, I think, the cutting edge of debate, and particularly regarding the growth of asset aggregators, as you put it, right, particularly the large index funds, and what impact that has on our corporate governance system.
I'm sure they have to vote. I'm sure they vote better than most of the mutual funds, the ones tied to Department of Labor standards. But interestingly, one of the first things I did when I set up my website in 1995, I wrote to the Department of Labor and I asked them, have you ever taken an enforcement action against any fund, any fiduciary for not voting in the best interest of, well, no, we haven't done that, but we've written a bunch of reports showing that there are problems, that that they're not actually even asking, the administrator or I guess the people running the money, have you voted and how did you vote? So.
Well, it's really a problem of intermediaries, right? So
Yeah.
only the very largest pension plans, vote in-house,
Right.
and it's typically delegated to a service provider, to an
Mhm.
asset manager, to make that decision, or it may be assigned to a proxy voting fiduciary who will vote on behalf of the plan, for that reason, for me, for many decades, proxy voting was, just viewed as a compliance exercise by asset managers that they have to vote. We'll
Right.
always vote with management, and it wasn't seen as a source of value creation, which I believe it is, right? Particularly for passive investors.
Right.
Right, for well-diversified investors, who are universal owners, and that's where shareholder advocacy really, has the opportunity to shine, both by improving individual company performance as well as uplifting the market as a whole. And I think that was really, some of the genius of the Gilbert brothers that I mentioned at the offset of this call. Their mother had invested in hundreds of companies. After the 1929 stock market crash, they essentially had an index fund that they ran before there was even such a thing of index funds. They were diversified, universal owners in public companies, and they recognized that, through their voice as shareholder advocates, they could improve accountability and hold corporate CEOs accountable, and that was something that we today are still emulating every time we file a shareholder proposal under 14A8.
Right. So one of the other things I did last year is I filed a bunch of proposals, the Rooney Rule thing, which I already brought up, the Rooney Rule for trying to get an employee on the board. And one of my techniques was, I didn't start this way initially, but as I progressed, I thought, well, let's file more of those at companies where the employees own a significant number of shares. So, like one of the most, unfortunately, General Electric, the stock has gone down so much that, I couldn't file there. But the stock, as I recall, General Electric employees, they own, I don't know, 10, 12% of the company. I did file at Procter & Gamble. I filed at Clorox. I filed at several companies. Now, it occurs to me that some of the companies that have high employee ownership probably have high employee ownership to discourage unions from forming at the companies. I'm kind of thinking that Procter & Gamble doesn't have a heavily unionized employee base. Anyway, the other thought that occurs to me is I couldn't, once I got those proposals filed, I could reach out to the public, for the 5 people that read my website and others, Twitter and wherever. But all this is leading up to the question is, does the AFL-CIO, through its, and maybe through affiliate organizations like Working America or other organizations, is there a way to somehow mobilize workers who own stock at companies and actually advise them as to how to vote? One of the other thing that comes to mind is Carl Herberger? I forget the last name, but he puts out the Optimizer, which I'm sure you're familiar with, Brandon. and he's bringing up, Peggy Forens was famous for this years ago at Prudential, where, if you vote, we'll send you a tote bag, and but Prudential had moved from a mutually owned company, to a stock traded company. But there was a couple of other companies in the optimizer. I forget what the companies were, but they're trying to get not only retail shareholders to vote, because traditionally retail shareholders vote in favor of management. They don't, they're not going to spend hours pouring through the proxy to figure out how to vote on each issue. Oftentimes they just vote for management. But they're also trying to get their employee stock ownership, those folks, to vote, because they typically support management. And, my question is there any way that we can influence those employee owners to, how do we get in? How do we reach them? How do we, get their attention that, well, when you're voting your shares, don't just vote them in line with management, because, your CEO is getting so much money, or this is happening, the auditor has been there forever and they're in the pocket of management, or whatever the issues are. How do we get to those employees? Have you guys thought about it?
Well, I don't, to your first point, I don't see companies using or viewing equity compensation as some form of union avoidance. To the contrary, I see it has been used as a management entrenchment tool, right? That
Yeah.
to prevent a takeover of the company, having the shares held in friendly hands, helps further that goal. Now, I think that the idea of employee ownership, is a good thing, but also has to be kept in perspective of meeting workers' basic income and retirement and health security needs first. And so and then the idea of workers voting in their own employer. I mean, we have to realize that for most people, they don't want to be making proxy voting decisions any more than they want to be making the decisions whether to invest their retirement savings in a particular company stock. That's why mutual funds are so popular. Just in the same way that most people don't want to change the oil on their own cars. They prefer to have a professional do it who knows more about car maintenance. There are certainly lots of people who change their own car's oil, and there are lots of people out there who vote their own proxies. But many do not. And frankly, if you look at the governance of employee stock ownership plans, they often will be voted by a trustee, right? Not necessarily voted by the plan participants directly, or there may be mirror voting in which it reflects the voting of how the rest of the plan participants vote. But that's also dominated by the fact that management employees, and the CEO has probably got the biggest holding of them all, right? I think you're raising interesting questions around employee ownership, and employees, of course, are not they're double stakeholders, right? They're investors through their retirement savings, but they're also employees and have a long-term interest in the company. And I think that voice needs greater amplification if we're going to have a successful and competitive U.S. publicly traded companies.
Yeah, when I talked to companies last year with the Rooney Rule type thing, to try to get a voice on the board, the response was, well, we have town hall meetings, we have suggestion boxes, we have all these things. But when the workers took over Rath Pack, I was working on a doctorate at that point. And I had a grant from the National Institute for Mental Health to study what form of ownership and management is best for society, best for workers, and best for the company. And when I went out to RathPac, I mean, here was a 5-story plant, a meatpacking plant. It was ancient, and and since they laid off by seniority, the average age of the RathPac employee when I got there after it became worker owned was probably 55, 56, something like that. So those workers were there, you know, way back in the day when they were organizing the plan. There was Pinkerton guards around and all kinds of crazy people. But I say we, I wasn't all that much involved, but I was a little bit involved. But, you know, they raised the productivity of that plant just enormously after it became worker owned, because workers really took an interest in, you know, how can we make this plant more productive? How can we compete? You know, of course, in the end there, it turned out that, you know, you've got International Beef Pack not too far away, and, you know, they're basically hiring illegal employees, and they're paying them, you know, $1.50 an hour, and these folks were getting $30 an hour or $40 an hour. So it's even if you're super productivity, you know, it's hard to compete with that. But
Well, it really goes to, you know, workers need to have a structure in place that they have voice,
right,
and they have to have trust. They have to have trust that, you know, staying after hours to help troubleshoot a problem will be rewarded, right? And that, you know, if you're an employer of choice, if you're an employer that pays high wages and offers stable employment, workers will look to you and choose you over competing employers, and that's what allows firm-specific human capital to develop the knowledge and commitment to your employer, because you have a feeling that we're all in it together. You know, and there are a variety of ways that can be achieved, and I believe collective bargaining is a central way to it, allowing workers the freedom to negotiate to both improve their working conditions, as well as to give them a voice to improve the productivity of their work, because they see the company as a whole gaining from that extra effort. And you know, organizations that succeed will figure out how to do that. And you know, I believe that unions are the best way to do that, because it gives workers that confidence that they can speak out and not suffer retaliation from their immediate supervisor if they raise you know, a better way to operate the business, and in fact they'll be rewarded for that. So it's, you know, we've got a long way to go in this country. You know, given private sector unionization is so low, and you have companies like Amazon so resistant to the idea that workers should have their own voice in how the company operates. And you know, of all the issues that we face in terms of, you know, the need for companies to be more diverse, to provide equal pay, to you know, to including workers in the decision making that affects the company's performance. I believe unions and worker representation on boards and other ideas like ESOPs are you know, important to getting us there.
I can't think of a better way to wrap up this conversation with just what you said, Brandon. And I think, you know, unions, we have to keep them top of mind, and the rights of employees to collectively bargain, that's got to be right there at the top. So I really want to thank you for joining us, and hope to see you again in the future in real life and also through Zoom. So thanks again.
All right. Well, thank you, Jim, for all your work, and look forward to seeing you at the shareholder meetings later this proxy season.
Yeah. Okay.